All right, let's get right into it. Welcome to this explainer on what I like to call the teen wealth building pipeline. If you're a focused learner looking to figure out exactly how to manage, protect, and grow those very first streams of income, you are in the exact right place. We're going to break down a highly effective, step-by-step roadmap for teenagers to completely take control of their financial future. So let's dive in.
Our agenda today is going to follow a very precise 5-step financial pipeline. 1. The 50-30-20 budget rule. 2. The magic of compounding. 3. Understanding risk and return. 4. Diversifying with index funds. And finally, 5. Maximizing tax-advantaged accounts.
So, let me ask you, what exactly are you going to do with that very first paycheck? We're going to track a single dollar from the second it's earned. Now, it's incredibly tempting to just go out and spend it all immediately, right? But without a clear system, you risk wasting some of the most critical early financial opportunities of your entire life. And as we'll see, where that income comes from is changing incredibly fast these days.
Because look, teen income, it's not just about bagging groceries anymore. While traditional jobs are still fantastic, and they actually make teenagers 27% more likely to be employed full-time at age 25, we're seeing an absolute explosion of modern earning methods. For instance, some people are running highly profitable Claude AI side hustles. There's literally a case of someone pulling in $13,000 a month just using Claude to automate things like writing dating profiles or running a luxury AI travel agency. But here's the catch. Any net self-employment income over just $400 is subject to a 15.3% tax. So making a lot of money is great, but smart allocation of that money, that is absolutely crucial.
That brings us right to step 1. The 50-30-20 budget rule.
This rule makes budgeting beautifully simple. You just take your after-tax income and chop it into 3 slices. 50% goes to your essential needs, stuff like transportation or bills. 30% is completely yours to spend on wants, like hanging out with friends or dining out. But that last 20%, that must be locked in strictly for savings and investing. Setting this up brings incredible financial awareness to your life from day one, and the best part is you're building a foundation without totally depriving yourself of having fun.
Which leads us to step 2, the magic of compounding.
Saving that 20% slice is insanely powerful when you're young because of this little concept called earning interest on your interest. Let's say you invest just $1,000 at a 5% return. After 1 year, you make $50, bringing your total to $1,050. But in year 2, you aren't just earning 5% on your original $1,000, you're earning 5% on $1,050. So you get $52.50 in interest. By year 3, you're earning 5% on $1,102.50, netting you $55.12. Over just 3 years, your money grew to $1,157.62, mathematically accelerating its own growth, all without you having to add a single new dime. That is compounding.
To really put this into perspective, think about how this scales over decades. If a 16-year-old contributes just $2,000 a year from a side hustle for exactly 3 years and then literally never contributes again, they will have approximately $100,000 by age 65, assuming historical average market returns. Just let that sink in for a second. 3 years of effort early on snowballs into a massive financial safety net later in life.
Okay, moving right along to step 3, understanding risk and return.
Now, time for a quick reality check. Out in the real world, not everything is a sound investment. Take a look at this real-world YouTube policy email that resulted in the removal of a channel called Winzoo Official. Why did they get banned? Because YouTube's policy strictly prohibits gambling content that promises guaranteed returns. When someone promises you super high guaranteed returns with absolutely no chance of losing your money, run the other way. That's a massive red flag. That's not investing, that's just a gambling scheme. And that brings us to a fundamental law of finance. Real investing means balancing your target return with your risk tolerance. It's a trade-off. If you want your investment to provide a potential 20% return, well, you have to accept the very real risk that your investment might fall 20% in value. You can't demand a 20% return, but only accept a 5% risk of loss. The illusion of easy money with zero risk is just that, an illusion. The higher your target return, the more risk you have to take on.
So how do we handle that risk?
That's step 4, diversifying with index funds.
Since we know risk is unavoidable, we manage it by utilizing specific, highly diversified investment vehicles. By definition, an index fund is a mutual fund or an exchange-traded fund, also known as an ETF, designed to simply follow preset rules to replicate the performance of a whole basket of underlying stocks or bonds. Instead of paying a fund manager high fees to try and guess which stocks will win, a strategy that academic research consistently shows actually underperforms the market, index funds rely on the efficient market hypothesis.
They skip the massive inefficiencies of active stock picking and just mirror the entire market.
And hey, you don't just have to take my word for it. The greatest financial minds in modern history are huge proponents of this strategy. Legendary investor Warren Buffett and groundbreaking economist Paul Samuelson have long advocated for index funds over trying to individually beat the market. They understand that for the vast majority of people, keeping your costs low and just capturing the overall growth of the market is the ultimate winning strategy.
The secret sauce behind why index funds are so effective is instant diversification. When you buy an index fund, you suddenly own tiny pieces of hundreds, sometimes thousands of companies all at once. You can even get global exposure with something like the MSCI World Index. This drastically smooths out volatility. If one single stock in that basket takes a huge hit, the impact on your overall portfolio is super tiny. Plus, it minimizes trading costs because you aren't constantly buying and selling individual stocks.
Finally, we hit step 5, maximizing tax-advantaged accounts.
Now that we know what to buy, we need to know exactly where to legally store these funds to maximize their growth. If you're in the US, the custodial Roth IRA is an absolute game changer. Here's how it works. Step 1, an adult, like a parent, opens the account as a custodian. Lots of brokerages offer these for free with zero minimum balance. Step 2, the teenager contributes their earned income, up to a limit of $2,000 per year, per child under some structures, which builds the financial habit and the asset itself. Step 3, once the teen reaches the age of majority in their state, which is usually 18 to 25, full ownership and control transfers entirely over to them. And the absolute best part? The growth is tax-free. And for our viewers up in Canada, you've got a very similar, incredibly powerful option, the tax-free savings account, or TFSA. Much like the Roth IRA, you can deposit funds annually up to a maximum amount and invest that money straight into index funds. Any money you make on those investments inside the TFSA is completely 100% tax-free. It is an absolutely essential tool for young earners to legally shield their investment gains from taxation.
So, the pipeline is built, the blueprint is right here, but honestly, none of it matters without execution. From setting up your 50-30-20 budget, to avoiding guaranteed return scams, to opening that custodial Roth IRA or TFSA and actually buying an index fund, the power is entirely in your hands. I want to leave you with this one provocative thought. What is your very first wealth-building step going to be today? Don't wait. The magic of compounding is already ticking. Thanks so much for joining me on this explainer, and I'll see you next time.